Hi, this is Darren of Future Balance CPAs. We specialise in online bookkeeping, online accounting, tax and business planning for small businesses based out of Toronto, Canada. Welcome to our new webinar series on essential strategy and planning tools for small and medium-sized businesses. Today's segment will focus on risk management strategies. After all, no discussion of strategy is complete without addressing business risk and appropriate risk management strategies. Everyone knows business is inherently risky, but this is not necessarily a bad thing. As they say, nothing ventured, nothing gained. Having said that, smart businessmen and women will ensure that risk is mitigated to an acceptable level and proportionate to the expected return on any given project. This all ties into overall enterprise strategy because risk management is not a cookie-cut solution for all organisations, but rather it's about selecting and controlling risks that are appropriate given the enterprise's strategies. Risk management and evaluation is done in all organisations, whether big or small. The major difference being that large organisations have oversight committees and complex risk models used to produce decisions with acceptable levels of risk. Risk assessment for smaller businesses, particularly owner-managed businesses, is done in the owner's and/or manager's head without a formal model, but with a gut feel and rudimentary inputs like, how much do I have to borrow from the bank for this versus what is the expected payoff? Is Mr. Lialot trustworthy to do business with, etc. The basic components involved in all risk assessment processes are as follows. 1. Internal environment. This involves a corporate culture, values and appetite for risk. This, of course, ties back to the overall corporate strategy. A. The internal environment will affect how risk is seen and assessed. B. Ask yourself, what business are we in? What do we sell and to whom do we sell? Which regions do we sell in? What sort of organisation do we aim to be? And will the assumption of this risk help us achieve or improve our predefined positions? 2. Risk assessment. A. Identifying internal and external risk events, how these events may affect the business and assessing possible management solutions. B. Ask yourself, just how risky is this decision? Try to quantify. For instance, perform a sensitivity analysis, which accounts for various outcomes based on a number of scenarios. 3. Risk management and risk response. There are 4 possible courses to follow after your initial assessment. A. Avoidance. Not engaging in the risk event because the risk profile may be too great or not compatible with the organisation's mandate. B. Mitigate. Means proceed with caution, with proper controls in place to define, monitor and deal with possible outcomes of engagement. For example, buy the stock but put a stop sell in place in case the stock suddenly free falls. C. Transfer. Push all or some of the risk onto a third party, for example with the purchase of insurance. D. Accept. Absorb a degree of risk with the expectation that it is coupled with a greater benefit. For example, when starting out, you may want to lower your prices below market with the knowledge and expectation that you'll lose on the sale, but with the hope that you'll attract traffic and gain in the long run. Future Balance CPAs is a Toronto, Canada-based online CPA firm. For more help and guidance related to bookkeeping, accounting, tax or business advice, feel free to contact us at futurebalance.ca or call one of our CPAs at 18447 FB CPAs to help you work smarter today.